A. Identify the role of the Accounting Information System, AIS, in the value chain. The AIS supports and integrates activities across the organization's value chain. From procurement of raw materials to delivery of finished goods and after-sale service, the AIS captures, processes, and reports financial and operational data that supports decision-making at each stage. AIS enhances efficiency and control. By automating transaction processing and maintaining accurate records, it improves cost management, inventory control, customer billing, and supplier payments, thereby increasing operational effectiveness and reducing errors. AIS provides information for strategic and performance evaluation purposes. It generates timely financial and managerial reports that help management monitor performance, control costs, evaluate profitability, and align operational activities with strategic objectives. B. Demonstrate understanding of AIS cycles. Revenue to cash and expenditure cycles manage external transactions. The revenue cycle covers sales, billing, and cash collection, while the expenditure cycle includes purchasing, receiving goods, and paying suppliers. Both cycles ensure proper authorization, recording, and safeguarding of assets. Production, HR/payroll, and financing cycles support internal operations. The production cycle tracks materials, labor, and overhead costs. HR/payroll manages employee compensation, and the financing cycle handles debt, equity, and dividend transactions. The general ledger and reporting system integrates all cycles. It consolidates data from each subsystem, ensures accuracy through reconciliations, and produces financial statements and management reports that support planning and control. C. Identify and explain challenges of separate financial and non-financial systems. Separate systems create data inconsistencies and reconciliation problems. When financial and operational data are stored in different platforms, discrepancies may arise, requiring manual adjustments and increasing the risk of reporting errors. Lack of integration reduces efficiency and transparency. Managers may struggle to obtain real-time, comprehensive performance information, limiting their ability to analyze cost drivers, productivity, or customer profitability. Internal control risks may increase. Disconnected systems can weaken audit trails and monitoring capabilities, making it more difficult to detect fraud, ensure data integrity, or maintain consistent reporting standards across departments. D. Define ERP and identify advantages and disadvantages. Enterprise Resource Planning, ERP, is an integrated information system that centralizes core business processes. ERP systems combine accounting, procurement, production, HR, and other functions into a unified database, improving data consistency and organizational coordination. Advantages include improved integration and real-time reporting. ERP enhances information accuracy, strengthens internal controls, streamlines workflows, and supports strategic decision-making through consolidated data access. Disadvantages involve cost, complexity, and implementation risk. ERP systems require significant financial investment, employee training, and change management. Poor implementation may disrupt operations, reduce productivity temporarily, and create dependency on system vendors. E. Explain how ERP helps overcome challenges of separate financial and non-financial systems. ERP integrates financial and operational data into a unified system. By using a centralized database, ERP eliminates data silos and ensures that accounting, production, sales, procurement, and HR functions share consistent, real-time information. This reduces duplication and reconciliation errors, improved data accuracy, and internal control. Because transactions are entered once and updated across modules automatically, ERP enhances data integrity, audit trails, and authorization controls. This strengthens governance and reporting reliability, enhanced decision-making, and cross-functional coordination. Managers gain access to integrated performance dashboards combining financial and non-financial metrics, enabling faster analysis, better forecasting, and alignment of operational activities with strategic goals. F. Define relational database and demonstrate understanding of a database management system, DBMS. A relational database stores data in tables organized by rows and columns. Each table represents an entity, and relationships between tables are established using primary and foreign keys. This structure minimizes redundancy and improves data consistency. A database management system, DBMS, manages data storage, retrieval, and security. It allows users to query, update, and maintain databases efficiently while enforcing data validation rules and access controls. DBMS enhances data integrity and security. Through backup utilities, user permissions, and audit logs, it ensures that information remains accurate, protected, and accessible for operational and reporting needs. G. Define data warehouse and data mart. A data warehouse is a centralized repository of integrated historical data. It consolidates information from multiple operational systems, enabling long-term trend analysis, business intelligence reporting, and strategic decision-making. Data warehouses support analytical processing rather than transaction processing. They are structured for complex queries, aggregation, and performance analysis, rather than day-to-day operational tasks. A data mart is a subset of a data warehouse. It focuses on specific departments or business functions, such as sales or finance, providing tailored data access for targeted analysis while maintaining consistency with enterprise-wide information. H. Define Enterprise Performance Management, EPM. Enterprise Performance Management, EPM, also known as CPM or BPM, is a framework for planning, monitoring, and managing organizational performance. It integrates financial and operational data to align strategy with execution. EPM combines budgeting, forecasting, consolidation, and reporting tools. These systems provide standardized processes for financial planning and performance tracking across departments. EPM emphasizes strategic alignment and accountability. By linking key performance indicators, KPIs, to organizational objectives, it ensures that day-to-day operations contribute directly to long-term value creation. 1. Discuss how EPM facilitates business planning and performance management. EPM improves planning accuracy and coordination. Integrated forecasting and budgeting tools enable scenario analysis, rolling forecasts, and real-time updates, allowing management to respond proactively to changing conditions. T enhances performance monitoring and accountability. Dashboards and scorecards provide visibility into financial and non-financial metrics, helping managers identify variances and implement corrective actions promptly. EPM supports strategic decision-making. By combining historical data, predictive analytics, and KPI tracking, EPM enables organizations to evaluate progress toward goals, allocate resources efficiently, and drive continuous performance improvement.